Good evening, everyone. Thank you for joining us for this webinar on Simplifying Budget 2015. The Interim Budget 2014 left the government with very little headroom to juggle. Now, all eyes are on the Union Budget scheduled for the 28th of this month. The budget brings with it many expectations from the industry and the investors. At the same time, Budget 2015 presents itself as an opportunity to put the country on a growth trajectory. How should an investor view the budget? How will it impact your personal financial standing? Which are the promising sectors that will be the harbingers of growth of India's story? We will discuss this and more with our two eminent experts today, Mr. Vinay Khattar, Associate Director and Head of Research, Edelweiss, and Mr. Sailesh Multani, Chief Financial Planner, Edelweiss. In the course of this interactive webinar, our experts will give you a spread on what to expect out of Budget 2015 and how you can use it to manage your finances smartly. You can write in your questions in the chat windows and they will be answered by our experts. I now invite our experts to take over.
Good evening, everybody. I'm Vinay Khattar, and I would be spending next few minutes in trying to take you through what budget FY16 actually means. And if you actually take a look at the longer period history of the budgets and the Indian economy, you find that budgets are merely cogs in the wheel. And this one especially so. If you look at last 3-4 years of history, let's just go to slide 1. India's stars appear to be aligned in a very significant manner. India's stars appear to be aligned in a very significant manner. Inflation is falling. The twin deficits, what we commonly call as current account deficit and fiscal deficit, both are coming down significantly, and the growth appears to be reviving. Now, all these factors are very, very important in terms of future of the country and the way economy is going to shape up over next 1, 2, 3 years. So let's take a look at the first one, which is inflation. What's exactly happening on the inflation front? If you've recently seen the WPI data, WPI is a wholesale price index, and that has in the latest data become negative. The core WPI has become negative. It's happened for the first time for us practically in many, many years, and we are probably one of the only emerging economies where core WPI is negative. So this tells you that inflation is practically killed. This also tells us that now RBI's monetary policy should begin to ease in a very significant manner. So what is inflation and why is it so important, and what is how does monetary policy impact? So just to give you a basic sense, if inflation is very high, our purchasing power, our ability to buy goods comes down. So tomatoes, which were selling at, let's say, 20 rupees a kg, become 40 rupees. All household items start becoming more and more expensive. People start demanding more salaries, your maids, your drivers, which means that our surplus capital, our surplus money in the house comes down. At the same time, if the inflation is up, the Reserve Bank is forced to increase the interest rates. If the interest rates go up, that means our EMIs go up. Corporates have to pay larger and larger interest rates, all net leading to a situation where individuals have less and less money to spend. We meet a lot of corporates, and just to give you an example, a company we just recently met makes an operating profit of 150 crores, but the interest outgo has become 160 to 170 crore for them, which was just about 70-80 crores 4 to 5 years ago. And this is not because they have borrowed aggressively, it's just because interest kept on going up year after year, and since company was not in a position to pay, it kept on getting accumulated. So higher inflation and higher interest rate has significant impact on all of us. Both consumption and investment need monetary as well as physical hand-holding, and if inflation comes down, the overall cycle begins to improve. For India, we are positioned in a what we call as Goldilocks combination. So inflation is very, very low, and we are poised for high growth. That means budget or no budget, things are going to become better for us, and budget will provide us dose of steroid. So if you look at the orange line, which is the CPI number, the CPI is coming down very significantly for last last 1 year or so, while the real GDP growth clearly shows bottoming out pattern and is poised to inch up. Moving to the twin deficits. So let me explain what these two deficits are. The first one is the current account deficit. Now, what is current account deficit? Basically, India trades with the rest of the world. Every country is connected to the globe in certain manner, and that is through trade. What we import and what we export leads to our trade deficit. So, just to give you some broad sense, India imports goods approximately worth $500 billion. At the same time, our exports are just about $330 billion. Net, we have a trade deficit which is $180 billion, which is a pretty large sum. In front of this trade deficit, we also get a lot of money from outside in terms of services exports, which is our IT exports, and so on. So our current account deficit, which is the net money which we are short. When we import, we have to pay money. When we export, we get money. So the net money which we are short, that is our current account deficit, has come down very significantly. It is just in the region of about $30 to $35 billion. At its peak, this was almost 2.5 times this number. So a current account deficit coming down leads to a situation that our need for dependence on foreign capital and foreign money keeps on coming down. The second deficit which impacts any nation very significantly is the fiscal deficit. So what is fiscal deficit? Fiscal deficit is the money that the government earns versus the money that the government spends. So let's say last year, total government of India's earnings were about 11 lakh crore rupees, while spending was close to 15 lakh crore rupees. Now, so this leads to a situation where we had a shortage of almost 4.5 to 5 lakh crore rupees, which government had to borrow. Now, what does government spend on? Government spends on a lot of things, including defense, education, social sector spending, subsidy. And one of the key subsidies that government used to spend a lot was the oil subsidy on gas, on diesel, and so on. Now, with the crash in the oil prices, the fiscal deficit is also beginning to come down very, very significantly. So on one hand, we have raised diesel prices. On second hand, the price of crude itself has come down, which has led to a situation of, in some ways, surplus for the country in this particular regard. So let's just take a deeper look at the numbers. We import almost 1 billion barrels we have imported till date in the current financial years, while refiners like Reliance and SR export a significant chunk in terms of their exports. So this has been as high as 400 million barrels. So net India has saved about $6.5 billion till date. Just putting in the rupee terms, this works out about 40,000 crore rupees. And for the full financial year, which is going to be there, if we assume that oil stays at closer to $60 a barrel, we could save about $19 billion, which is 5.5 lakh crore rupees. That's a very, very large sum for a country like us. This is especially given the fact that we import majority of our crude. Almost 70% of our crude gets imported. So this has had a very positive impact on India. And as Modi calls it, it fits his luck, then we should take benefit of that. And that's what's happening in India. If you take a deeper look at the numbers, if oil declines by $20, and these numbers are assumed at $110 when the oil was at peak, for a $20 decline in India, the decline in the price of oil, we are impacted by about 2.5 percentage points in our real GDP growth over a period of next 3 years. So if you look at this particular graph, India is the biggest beneficiary amongst all the countries in the world, which we have shown on the graph as Canada, Taiwan, US, Indonesia, Korea, China, Australia, and so on. So amongst all these countries, India is the biggest beneficiary for the price of crude coming down. And as I mentioned in the earlier slide, the fiscal deficit was one of the reasons which where things are going for us. Fiscal deficit is getting narrowed. And if you look at this pie chart, government of India has gained the maximum. It's gained almost 52% of whatever the money that India has saved, government has pocketed 52% of it, while consumers have got less than 10% and corporates about 30%. And this has happened, if you look at the right side of the graph, due to sharp hike in excise duty on fuel. Now, government has increased the fuel excise by about 3 to 4 times, which has led to significant impact where most of the gains has been pocketed by the government. And this will have a very positive impact in terms of government earnings and government revenues. Moving on to the next slide. The next big thing which has helped us is, on the current account side, is the lower gold demand. All of us know that gold prices have corrected very significantly from almost $1,800 an ounce. They are now trading at closer to $1,200 an ounce. In rupee terms, again, you can see a big drop. We are not sub 27,000 per 10 grams. So because of this fall in inflation and fall in gold prices, we are seeing a scenario where the demand for gold is coming down significantly. If you look at the right side bar graph, for last 7 quarters, the ETFs investments in gold have become negative. Our total gold imports are down to about $30 billion, which in rupee terms works out to about 1,80,000 crore rupees. At the peak, just 2 years ago, this number would be closer to $60 billion, which was a very, very large sum for India to import. And because the demand for gold was very high then, because there was very limited revenue for investment, there was very high inflation, and the gold was rising, so everybody was investing. So this number used to be very high, which has now just halved in just about a year or year plus. This has become the second reason why our current account deficit has improved so significantly. So what are the big challenges that the finance minister faces? The biggest one is how to get growth back into India. We all know that growth has not come back. If you guys have monitored the last quarterly results, most of the companies have reported subpar growth. Sales have not grown. Profits are down. Some of you would have seen Hindustan Liver's volumes just grew by 3%, and it still gained market share. So that speaks a lot about what is the state of other players in the sector and what's actually happening on the economy, where a player with just 3% volume growth actually gains market share. That means everybody else's demand is just collapsing. And we've seen that rural demand is down significantly, urban demand is down significantly. So if FM has to revive growth, then what does it need to do, and where are the key problems that lie? One of the biggest one is how to revive infrastructure growth. And this could be very counter-cyclical. This could be one of the key reasons, if we are successful, why Indian economy would do well. And that's infrastructure is one reason why China did so well over the years. And the biggest problem to revive infrastructure is that there is no money with the banks so that it can lend to corporates, especially in the infrastructure side. And corporates on the infrastructure side has balance sheets which are totally stretched. Most of the big companies have balance sheets, a huge amount of debt which is coming in, and they are not in a position to borrow anything to go after the new projects. We are seeing case after case where companies are just refusing to come up and bid for infrastructure projects. So that's the first one. Second one is revival in manufacturing. The interesting part is today India has very low capacity utilization. If I were to look at cement companies, steel companies, and so on, they are all operating at 70 to 71, 72% kind of capacity utilization. So this is a very, very low number. The number of these companies just break even at 72, 75% range. So practically they are just keeping their head above water in terms of operating profits. But otherwise, the sector is in a lot of pain. Second, the big regulatory hurdles, land acquisitions, and environmental clearances, and so on, are a big problem. The third is how to revive demand. If there is very low job growth, there is no manufacturing, the inflation is high, so the surplus capital in the household has come down dramatically, then how do you revive demand? And can government lead the way in spending, which happens in most of the countries? Infrastructure, where is the money? So few things which government can do in this budget, which everybody would be looking forward to, is to source capital to fund the infrastructure projects. And few of the things which government can do is, government is sitting on large tracts of unused lands, especially by ministries like railway. So after defense, railway is the largest landholder in India. And if government can find out some way to monetize parcels of certain lands that railway holds, that could provide quite a bit of funding. monetizing existing revenue generated regulated projects in road, power, and so on. So a lot of projects are there which are already running, doing well. They are going to run, have future earnings. So can government monetize a bit of these earnings to generate cash and meet its requirements today? Relaxing norms for investing in infrastructure projects. So today, if you look at infrastructure projects, they get either funding from banks, which are not ideally suited to provide long-term funding, or they get funding from term lending institutions. And there is very little development in the bond market, which should have been the primary source of these the funding for long gestation projects on the infrastructure side. So can government induce insurance and pension companies like LIC, GIC, HUDCO, EPFOs to start putting in money into infrastructure projects? So this would require change of laws, this would require certain other regulatory changes. But once this is done, this could provide large pool of capital to infrastructure projects. There are 79 sick PSU units. There is a possibility that some of these could get privatized. And if these get privatized, then that provides further impetus in terms of getting some more money. Government owns some very, very large entities like LIC, which it can list on stock exchanges and earn a lot of money. Next year, there is going to be certain degree of incremental savings. A large chunk of it will happen because of oil, as well as growth in tax revenues. So we're likely to get about 28,000 crores savings on additional excise duty on oil because of the raises that the government has done. The tax revenues will go up by 70,000 crores, and subsidies savings could be about 42,000 crores. So net government could have about 1,11,000 crores worth of savings, while the plan expenditure is just going to be increased by about 83,000 crores. So net government could be in a very sweet spot with taxes picking up significantly because of oil, and to a certain extent because of increase in the overall buoyancy in the economy. And the plan expenditure at this particular point, as we envisage, is going to be lesser, which would lead to a better situation for government to start thinking of spending more on the infrastructure side. Can Modi really revive manufacturing in India? And that's a big one, because manufacturing is the other leg which will cause India to grow well. Let's look at our last 60 years of India's history. So this is 1965 is the first year where we have data, and this is approximately what would be 1947 when Britishers would have left us. So our services economy was just about 32%, while our manufacturing was 23% and agriculture was 44%, way back in 1965. Over the years, agriculture has come down very significantly to high teens, while services has doubled from 30% to almost 60%. But what has stayed stagnant is the industry. And the manufacturing component within the industry component is just about 14 to 15%. So that tells us that over 60 years, India has practically not progressed at all in this particular sector, where manufacturing has just been about 13 to 14% of the GDP. Now, let's look at what exactly happens for most countries. So this is the typical cycle of industrialization and urbanization. I'm on slide number 14. The y-axis is manufacturing share in any economy, and the x-axis is the per capita income level of any country. So the blue dots, this one is Pakistan, the other one is Brazil, the yellow one is in India, the other yellow one is China, this is Russia, UK, and US. So you find that an average country follows this bell-shaped curve. As its economy starts picking up, as its average income, per capita income begins to pick up, the manufacturing component in the GDP begins to go up. And over a period of time, as the manufacturing mature, economy moves towards services economy. And the services component begins to come up while the manufacturing continues to go down. So for the developed economies like UK, US, Russia, and a lot of Western European economies, they are highly service-oriented economies, and relative contribution of manufacturing is low. What India has been trying to do always is try to move parallel. That means the manufacturing contribution has not gone up in the economy, while at the same time, just on the basis of services economy, we have been trying to increase our per capita income. We see that it's pretty difficult to achieve this. And the right way forward for India would be to begin to increase manufacturing contribution to GDP. And that's what Modi is trying to do. Let's compare India's manufacturing contribution to GDP versus the other countries in the world. So China has the highest contribution to manufacturing as a percentage of GDP, which is almost 32-33%. Indonesia comes next, then Germany, Japan, Russia. US is ahead of us, which is a very significant services-oriented economy, and then comes India. So in terms of India, we are much behind even the countries like Pakistan in terms of manufacturing contribution to GDP. So what is going to happen? What is going to make in India would do? It would spur labor-intensive sectors. It will increase more jobs in manufacturing. It will increase more disposable incomes. That will lead to more purchasing power, more demand. So we did some studies and we came to certain very interesting conclusions. So if you look at sector after sector, trading, the trade, hotel and restaurant, which is part of the services economy, adds about 6 jobs for every 1 million worth of sales which the sector generates. Transportation adds about 3.7 jobs for every 1 million worth of sales that it generates. Education, health and all generates about 9 jobs. And then comes manufacturing, where the relative contribution is low, specifically because manufacturing is becoming more and more capital and machine intensive, while at the same time the labor intensity is relatively low. But if you were to look at the overall space, the manufacturing, construction, mining, the overall industrial space adds up a lot to the jobs, which would lead to higher incomes and higher disposable incomes, which are key for any kind of uptick to happen in Indian economy. Reviving demand, and that's the last one for the finance minister. Eventually he's got to revive demand. If the demand gets revived, only then the economic pickup can happen. Let's look at what has happened in the last few years. These are two very interesting graphs. If you find the blue block, it tells you the gross tax revenue, what were the budget estimates, and what were the gross tax revenue actual collection. So except for FY11, where the red dotted line is bigger than the blue one, in all years government has significantly overestimated the tax collections, while the actual tax collections have been quite low. Because of this, you find on the right side graph that the planned expenditure which government had planned was actually down in a very significant manner because there was no earnings only. So actually planned expenditure in FY12 was just about 7%. In FY13 was just close to 0. And in FY14, the actual expenditure has just been about 8% of what was, while the planned expenditure was almost 30%. So this brings out the challenges that the government of India faces in terms of actual revenue collection, the tax collection, and what it can spend. Coming to the next one, the current government spending has been quite pro-cyclical to growth. So let's look at the left of this dotted black line. Governments normally do counter-cyclical spending. That means when the cycle is good, governments spend less. When the cycle is bad, governments have to spend more to pick up the economy. If you move to September 10 and come to the right side of the black line, you find this was also the period when Chidambaram had come in as the finance minister and Pranab Mukherjee had gone to the Rashtrapati Bhavan. The UPA started cutting planned expenditure very, very significantly because we were almost on the verge of being given as defaulter in terms of our ratings. S&P was looking at downgrading India. GDP was coming down, but they didn't really have too much of choices. So this is beginning to now play in India's favor, where growth is beginning to pick up while inflation is coming down, and government can again become pro-cyclical. That means government should start spending more and pick up the economic demand and traction. Moving on to the next slide. PSU investment, that is the public sector investment, that's one space where government is not dependent on private sector. So for most other places you find private-public partnership as the key. In this particular arena, government can start spending on its own. Central government capital expenditure is the blue line in the new graph, and public capex is the yellow line. And this is all as percentage of GDP. So you find that actually blue lines are much smaller. That means central government capital expenditure, which government spends out of its own pocket, is much less. While government can induce a lot of public sector undertaking to spend a lot more money. So this is now almost 8%. If I were to look at last year's number, FY 2013, 8%, which would work out to about almost about $160 billion. That's a pretty large sum to have, almost about 100 lakh crore rupees. So this is the kind of money, oh, sorry, 10 lakh crore rupees. This is the kind of money that the public sector can spend in India. Out of this, railways, NHAI, and some of these organizations have they have the capability, and they can spend almost up to their spending actually amounts to almost up to 3 lakh crore rupees. Now, public sector and government companies which are sitting on cash could provide a lot of impetus and can cause the economy to come out of the downturn in a significant manner. Government spending, as I've been saying, would lead the way. Approved capex of 76,000 crores to reduce transmission and distribution losses, and this has been Modi's key theme, where in Gujarat he had created a separate grid for farmers, and that's what we are now trying to do for all the states. This had led to turn around in Gujarat Electricity Board's very precarious financial situation, and Gujarat Electricity Board started doing very well after this scheme was introduced, and now Modi is trying to do that same for the center. Roads capital allocation is likely to go up to 50,000 crores. Normally they provide for 30 to 35,000 crores. From next year, this is going to jump up. Estimated total investment during this, the 12th plan could be 1,300 billion for metros itself. Delhi-Mumbai Industrial Corridor, this was one of the projects where UPA 2 did pretty well, and almost 6,000 billion rupees, that is 6 lakh crore rupees worth of investment is likely to happen in this particular segment. And 883 billion rupees worth of investment is envisaged over 2 phases of inland waterway. This is another Nitin Gadkari's key projects, and if inland waterways, if Indian rivers have to be developed as key waterways, a lot of spending could happen here. Clarity on PPP for railways and innovative methods for raising money for projects, whether it is in turn done through domestic money or through international money, through people putting money in Indian bonds, both at the domestic as well as at the international level, or through getting money from Japanese and Chinese companies as well as nations. This could be certain other innovative methods which we will come to know, at least as far as railway is concerned, by tomorrow. So while the budget piece is by and large in place, this is what we think in terms of budget. The last one that I would just want to spend a few minutes on is on the Indian equities. Indian equities we find is the best place to invest currently. Let's look at, a lot of people end up asking us that already cycle has happened. The Sensex has run up so significantly. It's almost more than doubled from its lows of 2009. Should we put money into this? And we just want to take them back to the last 40 years of Sensex history, when the bull run started. So 1979, when the first bull run started, and it lasted almost up to 1984-85, Sensex became 4.5 times. You look at the green number, which is 467%. When the correction happened, that correction was almost to the extent of 40% from the peak, but that was still way up above where it started from. And the next bull run started, it became 12 times, 1268%. The Sensex value became from its low of the bear market in 1989. And then it corrected by 48%, and then the next bull run started, which lasted up to 2009, and it went up by another 6 times, 622%. And the current rally is just about 2 and 2.2 times, which tells us that there is a lot of headroom for the Sensex to go up. And the bull market needs to be continuously played rather than being sitting outside. India is expected to again register one of the highest EPS growths. We are expected to grow by about 23% over next 2 years. And this is one of the best in the world. The nearest competing country with us is going to be US and Singapore, while most others are going to be on the downside. The next graph tells us something very interesting. This tells us that when the economy begins to pick up, we get what in financial terms we call as operating leverage. So let's say if a company is doing 1,000 rupees worth of sales and it has 900 rupees worth of expenditure, both in terms of cost of labor, cost of raw material, transportation, manufacturing, everything put together, and it makes about 100 rupees. So 1,000 rupees of sale, 900 rupees cost of producing all the goods and service, and 100 rupees is the profit that we make. Now, if the sales drops by 50 rupees, normally it is very difficult for us to for us to control the cost and bring the cost down in a significant manner. For a 5% drop in sales, the profits could drop by as much as 40 rupees. That means profits could drop by 40%. 40 rupees upon 100, since my profits were 100 rupees earlier and now they could drop by 40 rupees, that means my profits will just become 60 rupees. So 40 upon 100, that means my profit is dropping by 40%. This is what we call as operating deleverage. For a very small drop in sales, the bottom line, the profits contract very, very significantly. If you were to do a reverse of this, when the economy begins to pick up, the sales begin to move up partially, but the profits begin to move up very, very dramatically, because again, as we see, the cost structure does not changes very significantly. So the red line is, the blue line is the revenue growth, which tells you which is the lower one, and EBIT, which is the operating profit equivalent number, the red line, is much, much higher. For almost 30% increase in the sales growth in the period of between March 02 to March 04, in a 2-year period, my operating profit shot up by 50%. And if you come to the next one, again you find that blue lines have grown up a bit, but red line has gone up much more. Look at these 3 circles, and then I'll take you to the next slide. So if I go to the next slide, these are 3 periods that we have examined in terms of what has happened on the stock markets. So the dark blue line is the Sensex line, the green line is the property prices, and light blue line dashes is 1-year fixed deposits, and 10-year treasury bond is the magenta line. And the 3 circles which we saw on the previous slides are the ones which we are seeing here again. So you find that Sensex moves dramatically when the operating profits begin to move up. Look at the 3 periods in the red circles. Equities overtake most other asset classes during these periods by a very, very significant margins, which tells us the reasons why we should stay invested in equities. FIIs have been extremely bullish on India. India has almost received $19 billion since Jan 2014 till date. And the overall portfolio investments, both in equity and debt put together, has been very high at about almost $40 billion plus. FIIs are hugely overweight on India as compared to other emerging economies. I am done. I would now like to hand over to Mr. Sailesh Multani now for the rest of the presentation.
Okay, good evening, ladies and gentlemen. This presentation will deal with now what is the expectations from budget FY 2016 from the personal finance view. What is what is expected from this budget for the individual taxpayer. So we'll what we did is we actually talked to a lot of clients and a lot of investors and try to understand what will excite them about this budget, what will make them feel happy about this budget, and try to understand what are their wish list. So we have summarized them and we try to see that whether there is any scope for any increase in deduction limits or increase in certain exemption limits. And we did come across few sections which we believe can really help put more money in the hands of individual taxpayer. It will help him save more. At the same time, it will also help him consume more. So we'll look at which sections we think we expect there could be changes. The first one is the most popular one, the section 80C, which deals with deduction in respect of the contribution to public provident fund, investment in equity-linked savings schemes, payments for life insurance premium, contribution to employee provident fund. So all these are very popular, and there are limits on where money can be invested into these. But if you look at the history of this section, this was introduced somewhere around 2005 to 2006, and the original limit for this section was 1 lakh then, and it has been revised in the last budget. It was increased by 50,000 rupees, and it has now it stands at 1,50,000. Despite the fact that there has been an increase in the limit, we believe that given the fact that there has been an increase in income, over the last 10 years, individuals' income levels have gone up, and there is still a lot of scope for investment in the investments categorized under Section 80C. So we think there is some scope, for the finance minister to increase the limit for Section 80C. Coming to another popular section which really helps investors save tax is Section 80D. This section deals with deduction in respect of payment of medical insurance premium. The insurance premium which he pays for buying health insurance and critical illness insurance. The current limit stands at rupees 15,000 for individual assessee, individual taxpayer, for his spouse and children. For his parents, again, additional 15,000 limit is available. And if the parents are senior citizen, that is above age of 60, the limit is 20,000. Given the fact that the medical insurance premiums have gone up significantly over the last few years, in fact, they've gone up by 15-20% over the last few years. We believe that there is a scope, for increasing the limit under Section 80D. There has not been major changes in this section over the last many years. So we think that there can be an increase in the limits under Section 80D. Coming to the most important aspect of the budget, which every taxpayer, where every individual looks and awaits in the budget speech, is with respect to the basic exemption limit. This is the maximum income that is not chargeable to tax. Again, currently the basic exemption limit stands at 2,50,000 rupees for all individual taxpayers. It is 3 lakh rupees for senior citizens. Though this was again raised in the last budget from 2 lakh rupees to 2,50,000, we believe that this can be taken up to 3 lakh rupees. In fact, it will also match with what the direct tax code has to say about, which states that the basic exemption limit can be 3 lakhs. So it will be a step in that direction. Besides, increasing this limit will straight away put more money, more disposable income in the hands of the urban poor, the urban middle class, and this will have a direct impact on his savings, on the consumer spending. So we think that there is definitely a scope for increasing the basic exemption limit. Coming to some few other changes which we expect, and that is purely because we think it is high time that the numbers be revised. One of the popular allowance which everybody gets is the transport allowance. This is the allowance which is paid to the employee for the cost of transport between his residence and the place of work. And this section this is allowed under Section 1014, and this was introduced in 1998. Currently, the limit is rupees 800 rupees per month, and this was set in 1998. Similarly, the most common reimbursement which we talk of is medical reimbursement, which is exempt up to rupees 15,000 every year. Again, this limit has not been changed over the many years, and we think that the fact that the cost of transport has gone up, the fact that the cost of medical treatment has gone up, these limits need to be revised. Besides this, we don't think there is much which the budget can really offer to the common man or the individual taxpayer. Of course, there could be a lot of surprises, but given the fact that in the last budget itself, the basic exemption limit was increased, the Section 80C limit was increased, and also the PPF limit was increased. So we think that there is scope, but there may be limited scope for the budget. But whatever it does, it will put in more money at the disposal for the individual taxpayer. It will also boost savings, which the government really wants. It will also boost consumption, which is required to push the economy forward. So I think besides this, we'll wait for the budget, and definitely we will connect again after the budget to see and discuss more in detail how the budget will impact your personal finances, what should be and how should you plan your finances, and how should you go about making your investment strategies. That's it from my side. We'll now take questions.
Thank you, everybody. There are a few questions that people have asked, and I will just take some of them. So one of the questions being asked is, can Indian economy and budget 2015 focus on the growth for the lower income people? So let's just look at the structure of the Indian economy. This is a pretty interesting one, that how do you actually make the bottom of the pyramid people grow? Now, millions of these people are uneducated. They did not have access to any schools and any education. And the strata of society, which was a middle income group which had access to education, became very, very successful. And that's the reason why you find so many millionaires in India from services part of the economy, whether those are hotels, whether that is IT or travel and tourism. So that particular section has done relatively better. But for millions of very poor people, they have remained poor and have relatively remained untouched from this particular phenomenon. And one of the key reasons has been that in India, manufacturing has been very, very low, while agriculture has been predominant. So we were having a chat with Chief Minister of Maharashtra just a couple of weeks ago, and he said that almost 48% of my population is employed in agriculture, while I get only 10% of my GDP from agriculture. Because in India, land parcels are so small, agriculture productivity is so low, the purchasing power of farmer to buy even basic crop ingredients, to buy basic machines like tractors is relatively low. That leads to a lot of problems. So manufacturing is one way where an individual who has not had access to any education for 10, 15, 20 years of his life, and then suddenly he realizes that he's got no resource, he's not skilled. He can't work on the land because of various problems of land availability, as well as no money to put into agriculture. What does he do? And he's not qualified to become part of the services economy. So either they become people at the very low end of the services economy, which is your truck drivers, maids, and so on and so forth, or they can start becoming skilled to start getting jobs in the manufacturing sector. If manufacturing sector was to grow in a disproportionate manner, as I showed in the earlier manufacturing bell curve graph, a lot of people at the bottom of the pyramid in low and very low income groups could begin to get impacted in a significant manner. Just by doing a skilling course for 6 months, 3 months, or a maximum a year, a lot of these people get basic level employments which can then begin to move up. So India gets a very vast pool of workers, while at the same time, this pool of workers which was otherwise unemployable and was at the bottom of the pyramid could begin to move up. So I think manufacturing could be a pretty big one as far as India is concerned to cause growth at the lower end of the income band. The next question that I have is, due to rise in manufacturing activities, employment will be leading to higher disposable income. Would higher disposable income lead to higher demand and eventually very high inflation? Now, let's realize that economy is cyclical. You have high incomes which lead to high demand, which if not handled properly, that means if we have supply side constraints or we are just printing money and distributing to everybody to create demand, at the same time nothing productive is happening in the economy, that would lead to inflation. Now the trick is how to create demand, at the same time how to create supply on the opposite side so that the prices don't rise very much. So whatever is the demand that gets generated in the economy is met by corresponding increase in the supply side. So if India needs 300 million tons of cement in a year, and we have production capacity of only 270 million tons, the cost of cement will move up from 200 rupees a bag to 350 rupees a bag. But at the same time, if the supply in India is 350 million tons, then the prices cannot go up disproportionately and they will remain by and large stable. So the main thing to be done is to create manufacturing capacities and to create supply side solutions which would allow the prices to remain stable. And that was one reason why you find that UPA2 failed dramatically. A lot of the schemes that they ran, whether that was Narega and many others, they created huge amount of demand. At the same time, there was no productive asset created on the other side. You had problems on the green, environmental clearances, even the projects which were bid out on public-private partnership, they could not go through because of land acquisitions. Power plants came up, but there was no coal. So the supply side constraints never got resolved. Now what Modi government is trying to do is attack these supply side constraints. So the coal bidding which is happening, we are realizing that government is going to make large amount of money on the coal bidding which is just happening. At the same time, the coal which will come out of the ground will allow huge amount of power capacity to begin to generate electricity. Right now, if you would know, almost 60,000 megawatt of capacity in India is operating at less than 50% PLF. PLF is the plant load factor. And primary reason for that is there is no coal for us to run these plants. So supply side constraints will have to be addressed. If they are not addressed and only demand gets created, we would get up into a situation which we saw in last 3 years under UPA2. And that's what I think Modi is trying to tackle, and hopefully that will not happen. What is the main reason, the next gentleman asked, for the main reason for less growth in manufacturing sectors in the last 50 years as compared to services and others? What can we expect in the near future? So my sense is the key reason in India for low growth in manufacturing has been the mindset. Let's look at how do we look at an individual who is putting up any industry or who's putting up any plant. Psychologically, we feel that he's an industrialist. So he may be a very small guy, but all of us will club him in the same bracket as some of the richer industrialists. And Indians, especially post-independence, under the first premiership of Mr. Jawaharlal Nehru, where we followed a very socialistic model, and we were far more aligned to communist system in terms of their thinking, in terms of economy, where we started feeling that all capitalist and all capitalism was bad. If all capitalists were going to be bad and most of the manufacturing setups are going to be associated to capitalists, average Indians felt that that was not the right thing to do. Chinese, till the time they were following Mao's philosophies, were again very communist. But under the new leader, Mr. Deng, they started saying that the color of money does not matter. Eventually, we would want Chinese to be rich, no matter from where the money came, whether it came from industry or agriculture or whichever way. But we would want China an average Chinese individual to become rich. If India has to follow the same model, then manufacturing is the way forward, and it is going to pick up. A big reason why in 50 years India did not move up on the manufacturing graph was because of this mindset, which led to huge amount of controls, license permit Raj, problems in terms of land acquisitions, environmental clearances, which I think some of these are being tracked, and probably few of these are going to get resolved, which will cause manufacturing to begin to show some improvement as far as our GDP weightages are concerned.
There is one question which is come from Priya Matthew, is about is there anything this budget can do for working women? Earlier, if you look at the benefits which were available, there were differential benefits for working women and the male counterpart. But over the years, this differential treatment has gone away. For example, there was basic exemption limit was on the higher side for working women compared to men. But will there be any again, will there be any changes in the basic exemption limits? It is unlikely, but there could be some separate deductions or separate exemptions coming for women to encourage more women to come out and work. But apart from that, we really don't know. The difference, in fact, has been done away with if you look at the past history.
So the next question that Rokia Stephen is asking me is why there is less focus on agriculture to develop the economy, while Indian economy is risen from this green model. So a couple of things. It is not necessarily a correct view that Indian economy has risen from the green model, though we have had our share of green revolution, which in 60s and early 70s had a very significant on our food demand and food supply scenario, and contributed to the economy in a big manner. But Indian economy grew a lot because of contribution of the services sector. But why is there less focus on agriculture? Now let's look at the agriculture space per se. There are few things which are really challenging with Indian agriculture, and few things with which we are hugely endowed. At the same time, we necessarily don't get the benefit out of it. So just to give you a data point, we have about 350 million hectares of arable land in India, which is the largest naturally arable land anywhere in the world. No country has such a large body of arable land, and that is because of very big river systems both in northern and southern India, which allow irrigation to happen in certain manner, plus the monsoon, which impact almost all parts of India in some manner. So with the exception of a western state like Rajasthan, most other states get monsoonal rains throughout in some part of the year. So this leads to a situation where our agricultural productivity could have been one of the best in the world, which in certain segments it is. But the bigger problems that we face is the bifurcation or very small size of land holding. And it's an extremely politically sensitive issue where people with little understanding get swayed a lot. The land is normally inherited from fathers to sons, and the parcel size keeps on becoming smaller with passage of each generation. Now, just to give some basic economics, if I need to buy a tractor or I need to buy modern inputs for having good crops, I need capital. For me to have more capital, I need to have a larger parcel of land to sustain all those initiatives. Now, with just 1 acre of land, or in many cases less than 1 acre, just half an acre of land, how much can I produce? What is my abilities to buy goods like machines or fertilizers and other crop inputs to sustain this? Large parts of India are not irrigated evenly. So we get natural rains, we have river systems, but still large parts of India do not have irrigation round the year. And some of the reason is, a few of the reasons are in terms of availability of electricity to farmers when they want. Now these are some of the reasons why Indian farming has not been able to move beyond first green revolutions. In addition, genetically modified crops and seeds which can withstand attacks of pests and all, and their availability and distribution, all these lead to a cumulative effect where agricultural contribution has not really picked up in the manner where it could have. The problem is land aggregation has to be probably one of the early steps that any government has to take for it to be effective. That is such a political hot potato that land aggregation in no manner can happen. In 1950s or 40s, when India became independent, we had a zamindari system with zamindars were the large-scale land aggregators. And at that particular point in time, independent India felt that that is not the way to go. So the land was taken away from zamindars and distributed to small farmers. Nobody was allowed to hold land above a certain particular size. Today, you would want reverse of this, but politically it is a pretty difficult one to do. Until the time the problems like these are not resolved, in addition to certain others on the fertilizer side. Now urea is hugely subsidized in India. So urea, as we all know, is nitrogenous fertilizer, while P and K, the other two components for any soil to have even crops, the fertilizers are very expensive because the government subsidy on those are gone. So farmers tend to use N far more than they would do P and K, which leads to a disbalance in the soil, which creates challenges. So land aggregation, incorrect policies on fertilizers and so on have all contributed to agriculture contributing less to Indian GDP than what it could have.
Okay, there is one question which has come on what is the basic exemption limit for income tax, and where do we expect it to go? Now the basic exemption limit currently stands at 2.5 lakh rupees for all individual taxpayers. And like I said in my presentation, the limit is likely to go up to 3 lakh rupees. That is what we expect, and this will also be in line with the direct tax code.
I think railways can monetize the unsold land. There are a lot many ways in which railways can monetize the unsold land. If it is near the urban centers, the land could be given on lease for certain services. You could provide, if it is heavily populated areas, you could provide land for advertising. You could provide land for short-term municipal work in terms of parking and all, and get good revenues out of it. In urban mega centers, railways hold a lot of land which is just cordoned off and kept aside. It could be part of the city's development plans. It could be sold. There are areas in beyond the urban centers where this land could be used for certain agrarian activities. This could be given to farmers. In between, when the price of oil was very high, we were looking at biofuels. Jatropha plant, which grows in Indian wild pretty easily because of Indian climatic conditions. There was a talk of using thousands of hectares of Indian land along the railway parcels, which could be used for growing Jatropha plants. So there is no dearth of ideas. There are a lot of logistics centers which could be set up near where the railway infrastructure is, and railway could either sell the land or give it on lease to set up these warehouses, to set up these parks. So there is no dearth of idea. The issues are going to be only in terms of political will, and second and far more important, how does railway go about executing it? So these are the things which railway could look at and get in some kind of monetization of the land that it holds.
So thank you so very much to all our thank you so much for your time, Mr. Multani and Mr. Khattar, for joining us today. It was a very, very insightful session. And thank you for a very, very participative audience today. We still have questions coming in, but of course, budget is such a subject that the questions never end. So we would encourage you to log on to our budget coverage on economictimes.com, and post that we will have many more insightful webinars. So thank you for joining in today. We will conclude our session here today. Thank you so much. Good evening.